You know that weird feeling when you're trying to be responsible with money, and then one day you realize your diversified index fund might actually be making one giant bet on the future of AI? If you've ever wondered whether your retirement account is secretly more concentrated than you think, you're in the right place. Because today I'm going to show you why millions of investors who believe they're broadly diversified may actually have a much bigger exposure to a handful of AI-driven companies than they realize. And here's the part that surprised me. The biggest risk isn't that AI fails. The biggest risk is that many investors don't even realize how much of their future is tied to one specific outcome. In this video, we're going to break down what's happened inside major index funds, why concentration risk has quietly exploded, how AI has become one of the dominant forces shaping investor portfolios, and what I'm personally changing about my own investment strategy because of it. But make sure you stick around until the end, because I'm going to show you the one psychological trap that causes smart investors to accidentally make huge concentrated bets without ever realizing they're doing it. And once you see it, you'll probably look at your portfolio very differently. My name is Dave, and I spend way too much time thinking about how AI is changing the way regular people invest their money. If you're someone who is trying to invest responsibly without accidentally making one giant bet on the future of AI, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now, before we go any further, I'm not your financial advisor, this is not personal financial advice, and I'm not here to tell you I've cracked the market. I haven't. Nobody has. What I am saying is that the logic behind how I've invested for years is changing a little bit because the market itself is changing a lot. And if you're investing through an S&P 500 fund, a total market fund, a 401(k), a Roth IRA, whatever, this matters to you. Because here's the thing, for years the most reasonable investing advice for normal people was incredibly simple. Buy low-cost diversified index funds, keep investing, stop trying to be clever, and let time do the heavy lifting. Honestly, that was good advice, still mostly is. S&P Global SPIVA research has spent years showing that most active managers underperform over the long run, which is a very polite research-based way of saying the people getting paid to beat the market usually don't. And that's before fees. Vanguard says its average ETF and mutual fund expense ratio is 0.07% compared with an industry average of 0.44%. That difference sounds tiny until you realize that tiny percentages compound for decades just like returns do. So the old logic was strong. Don't overtrade. Don't overcomplicate this. Don't pay someone a bunch of money to perform financial astrology on your retirement account. I believe that. I still mostly believe that. But here's what most people don't realize. Buy the index used to mean something more diversified than it means today. And that's why I'm changing how I invest my money. Let me explain what changed for me. For a long time, just buy the S&P 500 felt like shorthand for own a slice of America. Simple, broad, rational. You weren't betting on one CEO, one sector, one story, one hype cycle. You were buying a piece of hundreds of businesses and letting capitalism sort itself out over time. But the market isn't frozen. Index funds aren't frozen. The weights change. The concentration changes. And lately, that concentration has gotten kind of wild. RBC Wealth Management found that by the end of 2025, the 10 largest companies made up nearly 41% of the S&P 500, and specifically 40.7% by year-end. They also pointed out that NVIDIA alone was nearly 8% of the index. Think about what that means in actual dollar terms. If you have $10,000 in S&P 500 fund, about $4,070 of it is effectively riding on just 10 companies. If you have $50,000, that's about 20,350s in 10 companies. If you have $100,000, that's roughly 40,700s in 10 companies. And if nearly 8% is in one company like NVIDIA, then out of that $100,000, you might have close to $1,000 tied to one stock without ever consciously deciding, yes, I would like one company to have this much influence over my future. That is not me saying the company is bad. That is me saying the word diversified starts getting a little weird when almost half the money is clustered at the top. Look, this is where people get confused. They hear 500 companies and mentally picture their money spread out like peanut butter. That is not what's happening. It's more like you ordered a variety pack, opened the box, and found out 40% of it is the same flavor. And right now, a lot of those biggest companies are connected by the same broad theme. AI. Different businesses, yes. Different revenue streams, yes. But still heavily linked by the same story: AI monetization, AI infrastructure, AI demand, AI expectations, AI capex, AI dominance. RBC's point was basically that what looks like broad diversification increasingly behaves like a concentrated thematic bet. And that bothered me. Not because I think AI is fake, not because I think every AI company is doomed, but because I realized I had quietly become more bullish on one future than I was comfortable being. That's the real issue. Because here's the assumption I want to challenge early. A great company is not automatically a great investment, and a great investment is not automatically a properly diversified portfolio. Those are different questions. A company can be amazing and still be priced for perfection. A sector can be transformative and still be overcrowded. A theme can be real and still become a bad place to concentrate too much of your net worth. People mix those up all the time. They say, but these are incredible businesses. Sure, maybe. That does not answer the diversification question. That does not answer the valuation question. That does not answer the psychological question of whether you are thinking clearly or just getting swept into the story everybody around you is already repeating. And that story right now is powerful. AI is everywhere. Every earnings call, every headline, every YouTube thumbnail, every tech conference, every person on LinkedIn suddenly acting like they were born inside a data center. It is very hard to live through a moment like this and not start assuming that the obvious winners today will also be the obvious winners for the next 10 or 15 years. But markets don't reward obviousness as consistently as people think. They reward cash flows relative to expectations. That is a very different game. This is where it gets really interesting. Because when I started thinking about changing my investing approach, I realized this wasn't just about mathematics. It was also about psychology, and if you don't understand the psychology, the math won't save you. There are at least 4 psychological forces messing with people right now. 1. Recency bias. The market has rewarded big US tech for years. So your brain starts whispering, this is just what wins now. You stop seeing a cycle and start seeing a law of nature. That's dangerous. Because the longer something works, the more permanent it feels, right before it reminds you that markets do not care about your feelings. 2. Narrative bias. Human beings love a clean story. AI will change everything, therefore the companies leading AI will automatically capture most of the value forever. That is a seductive story. But real life is messy. Sometimes the biggest value goes to infrastructure providers. Sometimes it goes to application companies. Sometimes it goes to customers who use the tech efficiently. Sometimes the winners create the value and the competition destroys the margins. The internet changed everything. That didn't mean every internet stock at peak hype was a great investment. 3. Social proof. If everyone smart looking on the internet seems to agree, your brain interprets consensus as safety. But consensus and safety are not the same thing. In markets, consensus is often where future returns get squeezed. 4. The illusion of diversification. This one is the sneakiest. You own an index fund, it feels passive, responsible, neutral, so your brain stops investigating. You think, I'm not making an active bet, but sometimes the most dangerous active bet is the one you're making by accident. That was the part that got me. Not that I chose AI aggressively, that I drifted into it passively. That's a very different emotional experience. Because if I knowingly put 40% of my money into a handful of AI-linked giants, at least I'd be taking responsibility for the decision. But if I'm doing it because I just kept auto-buying an index and never reevaluated what was inside it, then I'm not really being passive. I'm being inattentive, and there is a difference. So let's talk math, because money gets clearer when you stop talking in vibes. Let's say you have $200,000 invested, and let's say all of it is in a cap-weighted S&P 500 index fund. If the top 10 companies make up about 40.7% of the index, then roughly $81,400 of your portfolio is sitting in just 10 companies. That doesn't mean the other 490 companies don't matter. It means the drivers of your returns are more concentrated than many people realize. Now imagine you decide, I still want a big S&P 500 allocation, but I want to reduce how much one theme dominates my future. So you move 25% of your portfolio, $50,000, into other diversified holdings. Maybe some international exposure, maybe some value, maybe some mid-cap or small cap, maybe even an equal weight approach for part of it. The exact mix will differ. Now your S&P 500 position is $150,000, not $200,000, and 40.7% of $150,000 is $61,050. So without abandoning the index entirely, you just reduced your dollar exposure to those top 10 names from $81,400 to $61,050. That is a meaningful shift, not dramatic, not reckless. Not, I saw 3 TikToks and now I'm an international macro strategist. Just a measured reduction in concentration risk. That's the kind of change I'm talking about. Not going from disciplined to chaotic, going from automatic to intentional. And this matters because the AI spending wave is enormous. RBC said big tech capex more than doubled in the last 2 years, reaching $427 billion in 2025, with projections for about $562 billion in 2026. Goldman Sachs also noted AI capex recently equaled about 0.8% of GDP, and estimated hyperscaler AI capex would need to hit $700 billion in 2026 to match the peak spending intensity of the late 1990s telecom cycle. Again, that does not prove a bubble, but it does tell you this is no small side story. This is a massive capital cycle with huge expectations attached to it. And when expectations get huge, the room for disappointment gets bigger too. Now you might be thinking, okay, but if these companies are the strongest, most profitable companies in the world, why would I want less exposure to them? Fair question. Because this is not a morality play where giant companies are bad and smaller companies are virtuous. It's not that. It's about portfolio construction. If one area of the market becomes a bigger and bigger share of your portfolio, you should at least ask yourself whether that still matches your actual beliefs. That's all I'm saying. If your honest answer is yes, I'm totally comfortable with a large chunk of my future hinging on megacap AI winners, then okay, own that. But if your answer is, wait, I didn't realize it had become that concentrated, then you may want to adjust. Another objection, isn't this just market timing? Not necessarily. Selling everything because you think a crash is coming? That's market timing. Gradually rebalancing because your portfolio no longer reflects your risk tolerance? That's portfolio maintenance. Those are not the same thing. Another objection, aren't international stocks, small caps, or value stocks riskier? Sometimes yes, in different ways. This is why I'm not talking about some heroic all-in move. I'm talking about balance. I'm talking about admitting that one part of the market has become dominant enough that maybe it shouldn't automatically deserve every new dollar you invest forever. And another objection, what if AI really does become the biggest economic story of our lifetime, and these companies keep crushing it? Then great. If you still own a large core index position, you still benefit. That's actually part of the point. You don't need to make a binary choice between all AI forever and I renounce electricity and return to the forest. Most financial decisions get worse when people turn them into identity statements. You can believe AI matters and still want diversification. You can believe the megacaps are excellent and still think concentration risk is real. You can think the future is bright and still refuse to price perfection into your retirement plan. Here's what most people don't realize. The biggest risk in investing is often not volatility. It's unconscious exposure. It's waking up one day and realizing your financial life is much more dependent on one outcome than you ever intended. That outcome right now is something like this. AI demand keeps rising fast, AI infrastructure spending keeps paying off, margins hold up, regulators don't get too disruptive, monetization arrives at the scale people hope, and the companies leading today keep leading tomorrow. Could that happen? Absolutely. Could a less exciting outcome happen, where AI becomes incredibly useful but more commoditized than people expect, and the value leaks outward to customers, software layers, niche operators, and smaller businesses instead of just staying concentrated at the top? Also absolutely. That's the thing about transformative technologies. The world can change a lot without your current portfolio winners capturing all the upside. Railroads changed the world. Not every railroad investment was a winner. The internet changed the world. Not every internet darling survived. Smartphones changed the world. That didn't mean every company tied to the theme delivered endless excess returns. Technology matters. But the path from important technology to great long-term investment at this specific price is never automatic. And when people forget that, markets get weird. Look, I say this with love, but a lot of investors don't actually want diversification. They want the feeling of diversification while still mostly owning whatever has done best lately. That is not the same thing. That is performance chasing in a cardigan, and I'm trying very hard not to do that. So what am I actually doing? Not anything flashy. Step 1, I'm auditing my hidden concentration, not the number of funds I own, the actual economic exposure. Because owning 3 funds that all heavily overlap is not 3 different ideas. It's one idea wearing 3 hats. Step 2, I'm keeping a core but reducing automatic dominance. I'm not abandoning broad US equity exposure. I'm just not assuming it should absorb every marginal investing dollar unquestioned. Step 3, I'm adding diversification that behaves differently. That can mean international stocks, value exposure, mid-caps, small caps, or equal weight structures. Not because one of them is guaranteed to win next, but because they reduce the chance that one narrow story controls everything. Step 4, I'm using rules, not moods. If I rebalance, I want it tied to percentages and schedules, not headlines and adrenaline. Because if your investing strategy changes every time a CEO says AI 47 times on an earnings call, that's not a strategy. That's emotional cosplay. Step 5, I'm writing down the reason this is huge. Write 1 sentence. I am making this change not because I know what will outperform next year. but because I want my portfolio to better reflect my desired level of diversification. That sentence can save you from doing something dumb 6 months from now. Why? Because when the market rips higher without you in the exact maximum hot segment, you will feel stupid. And when that happens, you need a written reminder that the goal was never to maximize bragging rights at a dinner party. The goal was to build a durable financial life. That is different. And if you're someone watching this thinking, okay, but what can I do today? Here are the immediate moves. Open your portfolio and check the top holdings in your largest fund. Calculate what percentage of your total investments sit in the top 10 companies. Decide whether that matches your actual comfort level. If it doesn't, redirect future contributions first instead of panic selling everything. Rebalance gradually if needed. And most importantly, make sure your strategy is driven by risk tolerance, not by FOMO, that is boring advice. I know, but boring is underrated. Boring built more wealth than excitement ever did. I think a lot of people are going to make one of two mistakes over the next few years. They're either going to go all in on the AI story because it feels inevitable, or they're going to panic and do something equally emotional in the opposite direction. I don't want to do either. I want to stay invested. I want to stay rational. I want to respect what AI might become without quietly letting it become a bigger bet in my portfolio than I ever consciously chose. That's the shift, not fear, not hype, just clarity. Because good investing is rarely about finding the one perfect prediction. It's about building a system that still works even when your predictions are wrong. And look, if there's one thing history has taught us, it's that people are wrong a lot. Especially when they're most confident. Especially when the story sounds unstoppable. Especially when everyone around them starts talking like the future has already been priced, packaged, and delivered. So yeah, I'm changing how I invest my money because of AI. Not because I think AI doesn't matter. Because I think it matters enough that I don't want to treat my exposure to it casually. If this video helped you think about your own portfolio a little more clearly, hit the like button, subscribe, and in the comments tell me this. When you look at your investments, are you actually diversified, or do you just feel diversified? Because that question might be worth a lot more money than people realize.